Here we sit in the beginning of 2026. What should you be doing in the first part of the year so that we don't have to pay so much in taxes or we don't get stumped? Well, today we're going to talk with Taylor Wolverton, the Director of Financial Planning and Tax Strategy with Peace of Mind Wealth Management. She is going to lay out some big time reminders, so listen all the way through.
We hope you've been enjoying all the episodes from Secure Your Retirement. If you'd like to keep learning and receiving these episodes, hit the subscribe button and the bell so you receive alerts when they come out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in.
Welcome, everyone, to Secure Your Retirement Podcast. Excited to have you here today, Taylor. Taylor is right here in Raleigh, so that's exciting. So thank you for coming on the podcast.
Yeah, happy to be here.
Yeah, and so whenever we have a chance to have Taylor on the podcast, as you know, we always use the scenario of trying to talk about taxes and try to look at things. A lot of times we're talking about taxes, though, kind of like at the end of the year, like what do we want to do before we get, before the December 31st. And I think today what we talked about as we were thinking about what would be a good thing to deliver on this topic of taxes is maybe as we're in the beginning of the year, what are some things we need to know for the whole year, but also some things that we don't want to do in the beginning of the year that could mess us up as we get closer or deeper into the year, closer to the end. So I think this is going to be a really good episode, and I think we're going to hit a few different topics, and Taylor's going to be our tax guru on this and kind of walk us through. So I think the first thing is talking about 401ks. There's different things that we can do within our 401ks as far as the amounts that we can do. If we're of a certain age, we can actually do catch up. So I know you said you've been getting quite a few calls, Taylor, on this topic. So can you kind of walk us through some of those things that people are asking about?
Right. Yeah. One thing that's actually new starting in 2026 is how catch-up contributions for 401ks are treated for some people. So the standard 401k maximum contribution in 2026 is $24,500. However, if you made more than $150,000 in wages last year in 2025, then your catch-up contributions are going to be treated differently. So if you're over the age of 50, you're eligible to contribute another $8,000 in your 401k in addition to the standard. So your total 401k maximum is $32,500. But like I said, if you made more than $150,000 in wages last year, that $8,000 catch-up now has to be treated as a Roth contribution. If your employer plan does not allow for Roth contributions, then you cannot make a catch-up contribution at all. So a lot of people's like HR representative have been emailing them and letting them know, hey, your catch-up contributions have to be Roth this year. Do you still want to make the catch-up or do you want to opt out of it? So that's been kind of a lot of the conversations that we've been having. I would say generally, if you're still able to make those contributions and you're comfortable with what that does to your net paycheck, I would still make the contribution, but just know now you are paying taxes on those dollars today, as opposed to paying taxes on them later when you take them out of your account as a distribution.
Yeah, I guess in the reality of that is I'm going to pay tax on those dollars no matter what.
Yeah.
And so if I put the money over in there, use the catch up, I am losing a little bit of a benefit that I had last year.
Right.
But if I put the money in or I don't put the money in, I'm still paying taxes on it. So at least if I get it into the Roth category, anything I make up and above that is whatever earnings I get are going to grow tax free.
Yes,
Yeah.
that's right.
Yeah. So something I guess for everybody to think about. I know when I first got that notice myself, I was a little upset about that and like, oh man, that's kind of crappy. But then just rationalizing on it, I guess it makes sense because otherwise I'm, still going to have to pay the taxes. Okay. Now there's
one last thing on that too, actually. One other thing just to make note of, if you're between the ages of 60 and 63 by the end of this year, your catch-up amount is actually higher. You can do the catch-up of $11,250. So your total 401k with the base or the standard 24,500 plus your catch-up, your maximum is going to be 35,750. But that is only for ages 60 to 63. So just one other thing to be aware of, if you are in that age category this year, you can contribute even more.
Yeah. So I guess just thinking about that, what you would want to do is contact your payroll folks at your work and say, hey, I want to up myself to make sure that I'm getting the max that I can put in there if I so choose to do so.
Yes.
Yeah, very good. All right, so we talk about this all the time. I always tell people you got to make decisions before December 31st. If you don't make the decision before December 31st, you're really kind of dealing with what the outcome is of whatever you did in that year. But there are a couple of things that we can do after December 31st that will actually help us for the prior year. So if I am sitting here into 2026, I know there's a thing or two that I can do. So can you share those with us?
Yes, one thing I did want to make note of, you can still contribute to your traditional IRA or your Roth IRA for the year 2025 up until April 15th or the tax filing deadline 2026. So if you want to contribute to those accounts for 2025, you do still have time to be able to do that.
Okay, great. Okay, so now we're going to talk about one that I think is really a key to helping us out as we think about how we do charitable giving. And I think this one's really important. And I always tell people we're not saying go give to a charity just to give to a charity. We're not trying to say that giving a charity is going to necessarily be the right thing to do if you're not charitably inclined. However, if I do give to a charity, there's things I need to know about charitable giving, and I think there's a few points that you've got planned to talk to us about that on this one, Taylor.
Yes, I'll start with the most straightforward one, which is if you are eligible for qualified charitable distributions or QCDs, which to be eligible, you need to be over the age of 70 and a half. So if you're turning 70 and a half this year, or you're already over the age of 70 and a half and you are charitably inclined, then the most tax efficient way for you to donate is through those QCDs or the qualified charitable distributions, which means you make donations directly out of your traditional IRA, and any donation that you make is completely tax free. If you are also RMD age or required minimum distribution age, then any charitable donations you make through that method will also count towards your RMD.
I just want to say on that one time, what we see a lot of times is that if you have a charity where you're giving to them monthly, and so you just kind of have a withdrawal coming out of maybe whether it be a credit card or a paycheck, I mean, not a paycheck, a checking account, and you kind of have that on autopilot. You might want to think about that, especially if this year you're turning 70 and a half, because you might want to rethink that and say, let me turn that off, and then I could just do a lump sum distribution out of my IRA, because it has to go directly from your IRA. You cannot receive the money from your IRA and then go give it to the charity. It has to be written to the charity out of your IRA for it to qualify as a qualified charitable distribution. So just think about that. That's why I was saying when we were talking to Taylor, I was like, there's things we might want to remind people because we're sitting here in the beginning of the year. And if I have things on auto pay, I might want to go fix that, especially when it comes to this idea of the QCD.
Exactly. Yeah. Plan it out from the beginning of the year. If you want to donate, I'm just making up a random example, $5,000, and you donate it in cash. And then we have a conversation later and you realize, oh, I am QCD eligible. I want to do that method. Then if you've already made the donations, it's already too late. So it is something that is ideal to think about from the start of the year, so you can choose the best method rather than have the hindsight to realize, oh, I should have done it a different way.
Yeah. Any other things on charitable contributions?
Yes. In that kind of same vein, if you're not 70 and a half, if you're below that age, then another strategy to consider is donating stock. That's another thing to think about from the beginning of the year. If you know you're going to donate whatever amount you have on your mind, whatever your goal or preference is, then think about donating stock if you have that available to you. The advantage to donating stock, especially appreciated stock is what I'm referring to specifically. If you donate appreciated stock, then you can avoid the capital gains tax that you otherwise would pay by donating that stock. So that is another thing. If you have appreciated holdings in your brokerage accounts and you have some stock that you wouldn't mind donating to a donor advised fund, then that's the best way to go about it. And another thing, you want to just donate the full stock amount at the beginning of the year rather than get to the end of the year and realize, oh, I donated all this cash out of my checking account. I would have preferred to donate stock. That would be more ideal, but now you can't undo it. So.
All right. Excellent. Well, I know that the other thing that comes up sometimes that when we get to the end of the year in particular, and you're having your tax strategy meetings and those kind of things, and then we find out that, oh, wait a minute, you took income in such a way that's actually probably not the best because it affected what we could do, say, for example, with Roth conversions. And so here we are again at the beginning of the year. What are some income planning things that people might want to think about and strategies they might use about how they're going to take income this year if they're retired in particular?
Yeah, it can be hard to speak in generals on income planning because everyone's situation is so different. But I would say generally, especially if you are wanting to do a Roth conversion for income this year, if you have cash available, that's the best to spend as opposed to taking distributions out of your traditional IRA to spend that instead. So if you have cash available, that's the best place to go for income first. And then I would say as well, if you have brokerage accounts, then that's also ideal for income planning because that's treated differently for tax purposes as opposed to taking distributions from your traditional IRA. And those are conversations we're having with people and even just amongst our team members constantly throughout the year. Like, oh, this person needs to buy a car. Which account should we take it out of? What's most tax efficient? So it's even like an ongoing conversation amongst us that we're revisiting every single time income does need to come out.
Yeah, that's a big one. I've had people before where hey, I'm going to go buy a car, and then you go take $50,000 from your IRA. Well, that's all income. And could we have done that maybe a little bit better way? Even if I'm doing a Roth conversion, I might even recommend take the loan out on the car, especially if I'm sitting, 6 months, 8 months, 10 months into the year, and then pay it off the beginning of next year so that I don't have that income that I got to claim. So there's different things to think about how we deal with these types of things if my only option is pulling money from an IRA.
Right.
So that we can keep our income low. That's what we're trying to do for the conversion. We're not going to be able to do it forever, but for the conversion years.
Yeah. And kind of same thing, same thought process with selling stock in general. If you are going to sell stock, be aware of what that realized gain will be when you sell, because the gain is what gets reported on your tax return as income. So I'm not saying if you want to do a Roth conversion, don't sell any stock at all. That might not be possible. There are other goals and other considerations that you could still be wanting to sell the stock for, but at least have an awareness of what that's going to do and the consequences that that's going to have on Roth conversion conversations later on in the year.
Excellent. Okay, I think our final thing that we're going to chat about is our paying of taxes and making sure that we do that in a timely fashion. So if you want to walk us through our estimated tax payments.
Yes. So for paying taxes in general, you can have tax automatically withheld from your income sources, like your Social Security, like your pension, like your wages, IRA distributions, things like that. Or you can pay your tax online through estimated tax payments. And those payments are due quarterly. The IRS does require that you pay your tax as you receive income throughout the year. So they do have due dates for when you need to make those estimated tax payments. Again, not everyone even needs to make estimated tax payments, but if that is your strategy for this year, the due dates in 2026, the first quarter is due April 15th. The second quarter is due June 15th. The third quarter is due September 15th. And then the last quarter for 2026 tax will be due January 15th of 2027. So we still have a few months before the first quarter is due, but just again, have an awareness as you're planning out your income throughout the year for those due dates and when taxes need to be paid so you can be prepared for that.
Excellent. Well, anything else come to your mind while we're chatting it through?
One other thing on charitable donations, actually, that's new for 2026. I think we've talked about this previously, but just as a reminder, if you take the standard deduction, historically, charitable donations do not really benefit you at all. But now, because of the new tax law that was passed last year in 2025, one thing that has changed is that if you're donating cash, well, first let me say, if you take the standard deduction and you donate cash, you will actually be eligible for an additional deduction on top of your standard deduction for up to $1,000 in charitable donations if you're single or $2,000 if you file jointly. So that's brand new for 2026. That's the first time that we will see that go into effect. But just another thing to think about with, standard versus itemizing in charitable donations. Historically, when we haven't seen a charitable benefit from taking the standard deduction, now that is actually going to be a possibility. So that will only benefit people in that situation.
Well, excellent. Well, thank you so much again, Taylor, for hopping on and kind of walking us through this information. As I always like to remind you, we do have a written blog on this same topic. So we went through a lot of numbers, and a lot of reminders. So you can go to pomwealth.net, go to the blog page, and you'll see a whole article written on this particular topic as well. And it'll be a nice resource that you can read through just to remember all these different points. But as always, we certainly do appreciate you listening today. We look forward to talking to you again next Monday.
We hope you have enjoyed this episode of Secure Your Retirement. If you would like to learn more, we have actually created an online course called 3 Keys to Secure Your Retirement. This video course helps you to think through all the different steps as you get ready to plan for and live throughout retirement. You can access this by going to our website, pomwealth.net. In addition, you can also subscribe below to our podcast called Secure Your Retirement.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.